Hi there, and welcome to Chapter 10, Stockholders' Equity. Businesses have three basic options when deciding which form a new business will take. These include what we call a sole proprietorship, where there is one owner. A partnership, which we have to have two or more owners. And then we have a corporation, which acts like an individual. And we're going to talk about those for a few minutes here. When we talk about the corporate form of business, it distinguishes itself from sole proprietorships or partnerships as a result of the following corporate characteristics. One is it has a separate legal entity, the ability to raise capital, limited liability of the owners, transferability of the ownership, double taxation, and regulation. And now we're going to visit each of these characteristics. A corporation is a separate legal entity. It is formed under state law by submitting articles of incorporation to a state government, such as California, and requesting the establishment of a corporate entity. The state that gets the most corporations wanting to be a corporation in it is Delaware, because it is the easiest place to start a corporation. So there are many corporations, even though their corporate headquarters may be in Seattle or Palo Alto or wherever. They're incorporated in Delaware because it's the easiest way, it's the easiest place to get incorporated. The articles describe the business of the corporation and request authority to sell ownership shares. We call those ownership shares stock. Once the articles are approved, the state grants a corporate charter that effectively creates a new legal entity, which is the corporation. In most cases, this new legal entity can buy, this is very important, can buy, own, sell assets in its name, borrow money, or sue and be sued, just like an individual. There are certain advantages to being a corporation. One is the ability to access capital through the sale of stock. Capital effectively is cash. Many sole proprietorships and partnerships have limited access to the capital needed to successfully operate or expand their business. What has to happen for this is a partner or a sole proprietor, it's on their backs to get capital, either through loans, contributing their own money, but it's on their back, and they have limited access to raise cash. Remember, we're talking about capital being cash. In contrast, corporations can access capital through stock sales to investors, who then become stockholders. Most corporations begin by selling stock privately to a few owners. And while many corporations stay privately owned, others go public by offering stock to the public through what we call an initial public offering, or we call an IPO. That's what Facebook went through just a year or so ago. Such public offerings can generate substantial amounts of capital. Remember again, capital is cash. For example, Google in 2004 IPO raised over $1.6 billion. $1.6 billion. If needed, a corporation can continue to raise capital in the future by selling more stock. Google followed its IPO with a second stock offering in 2005, and it raised another $4.2 billion. Corporations raise money like this to buy buildings, to do R&D, to buy equipment, software, those kinds of things. So it's a way for them to get money without going to the bank to raise money. In addition, Apple was just talking about today that they're going to start to buy some of their stock back, and we'll talk about that here later in the chapter, as well as pay out money to the shareholders in the form of dividends, and we'll be talking about that a little bit later as well. Advantage is what we call the limited liability of the owners. Under a sole proprietorship and a general partnership, owners are personally liable for the actions and obligations of their business. In other words, they're personally liable. However, stockholders normally have no personal liability in a corporation. If a corporation defaults and cannot meet its obligation, creditors cannot seek the assets of the stockholders as compensation for the corporate default. So if I own stock in Apple and Apple doesn't pay their bill, those people can't come back to me to get payment for their bill. They can only pursue the assets of the corporation. So they can only get the money or have the corporation sell stuff to pay them. As a result of this limited liability, stockholders stand to lose only the amount of their investments. So if a company goes bankrupt and I invested $10,000, I can only lose $10,000. It's limited to the amount of my investments. We call that limited liability of the owners, and we consider it a significant advantage to corporations. Another advantage is the ease of transferring ownership. That is totally true in a corporation. When a sole proprietor wants to transfer his or her ownership to another individual, the business itself must be sold. So in other words, we must sell the business when we want to make a transfer for a sole proprietorship. For a partnership, we can sell the interest of the partnership to another investors, but all partners have to agree, and then you have to form a new partnership. So it's very burdensome in transferring a sole proprietorship and a partnership. However, in a corporation, it is very easy because in a corporation, you just sell it through stock sales and then you get capital. So very, very easily done in a corporation. Take a look at some of the disadvantages of a corporation. Obviously, we've looked at the advantages, but now we need to take a look at the disadvantages. One is the double taxation of income. A corporation's income is taxed at the federal and state levels at their own rate. They have their own tax rate, and they have their own tax code. Dividends are then paid to shareholders, and they're also taxed at the personal rate. So therefore, it's getting taxed at the corporate rate, and then it's getting taxed at the personal rate. As a result, a corporation's income that is paid in dividends is taxed twice, once at the corporate level and a second time at the personal level. In contrast, the income of a sole proprietor or partnership is reported and then is what we call passed through to the personal tax returns, so therefore those are only taxed once at the personal level. This is always a point of contention in election years, especially from the Republicans and such, and they want to get rid of that. They want to lower the corporate tax rate to make it more friendly for corporations to come to the U.S., as well as not tax dividends, so therefore we don't have the double taxation. In addition to taxation, we also have a lot of regulations. So to the extent of regulations, Consider some of the reporting requirements of a publicly traded company. In addition to SEC filings, there are many other reporting and legal requirements arising from state laws, stock exchange regs, IRS, and Congress. These reports result in significant amounts of time, labor, and resources of a corporation. Some of those reports or various filings, we have a 10-K, which is the annual report. We have a 10-Q, which is the quarterly report. And then we have an 8-K, which is kind of in between. So now what we're going to do is we're going to go ahead and take a look at how we issue stock and receive money for stock.